Good morning, David. Thank you very much for the invitation to present today and say a few make a few background comments on copper. If we could just move through the slides, that's the normal disclaimer. Just in terms of the fund, we're about 20% invested in base metals, and the lion's share of that is copper. So copper is important to us and makes up a substantial portion of the portfolio. Just moving on. Look, just a couple of quick slides on the market, and we're focused on the junior resources market. But this is data from Austex, the whole of the ASX resources market from the tiniest company through to BHP. Average share prices, you can see that 2023 was a terrible year. But the start or since about February this year, we've seen a reasonable uptick in the average share prices on the ASX. So there is some light at the end of the tunnel. Just next slide, please. The junior sector versus the majors was really hit hard in 2023. This is a chart of all sectors from the US, the S&P 500, either the big boys, versus the Russell 2000, either the smaller caps. And you can see that the move away from the small caps has been across most sectors. So it wasn't personal to the mining or resources sector. Next slide, please. And here's some data focused on the ASX. You can see that the larger caps have done very well over the last 24 months. On the left-hand side, the caps greater than 70 odd million, up 70% in the resources market, but the nano caps down 70% over the last 2 years, sorry. But in the last 3 months, there's been an improvement in the more junior sector, and you can see that the sort of the mid range there, sort of sub 60 odd million, has improved 13% over the last 3 months. So hopefully, we are seeing a bit of a trickle-down effect into the much more junior end of the market. Next slide, please. Just to set the scene here, moving on to copper itself. Here's the very long-term copper price going back 70 odd years. You can see, if you cast your mind back 25 years to around the year 2000, you would have been very confident that the copper price wasn't going over $50 a pound anytime soon. But by the mid-2000s, we saw the copper price go on an absolute tear during the 2000s mining and commodity boom, and it hit $4.50 a pound in 2011. So and that's where we are back to today. So it's a very exciting time to be talking about copper. Next slide, please. This is the copper price over the last 30 odd years, plotted against the ASX Junior Resources Index. And it's interesting to note that back in the 2000s mining boom, the copper price and the junior resources sector moved largely in sync. But that coincidence has completely broken down in the last decade or so. And perhaps some of the reasons for that are back in the 2000s, there was capital available to develop projects. Companies, junior companies could have some level of optimism that they were be able to take their project through to production. Whereas today, partly because some of the majors committed some pretty bad capital investment decisions back in the 2000s, there's not nearly as much development capital available today. So moving your project from pre-development through to production is a lot tougher. I think also we've seen a reduction in the number of copper players on the ASX, with things like Oz Minerals getting taken over, Demetallica, etc. So there's just not the opportunity to invest in copper as much as there might have been back 20 odd years ago. Next slide, please. Just very quickly looking at the price performance over the last 12 months of the big boys. You can see Freeport McMoran has done really well over the last 12 months. First Quantum has been very much in the news due to the suspension and looks like long-term hiatus in production from its Cobre Panama mine, which produces up to, was producing up to 4 or 5% of the world's copper, and that has had an impact on copper supplies and copper price, particularly copper concentrate supplies. Next slide. And then turning to Aussie producers, you can see the last 12 months somewhat going sideways, but certainly the last 2 or 3 months we've seen a real positive uptick in those share prices. Next slide, please. And then some of the pre-production companies had generally a tough 2023, but the last couple of months since February have been remarkably good for a number of these pre-development copper companies. Moving on. Now, this slide is probably my favourite one. I think it's really important. Basically, it's showing world global copper consumption going back to 1900. I think this slide actually was something that Robert Friedland put up. But in summary, you can see that global copper consumption doubles roughly every 25 years. And we're sitting around 27 million tonnes at the moment. 2023 take us through to 2050. On that basis, you are well over 50 million tonnes of copper consumption by 2050, which is a really big amount. And everybody wants copper. So the big boys, BHP's had its second bid for Anglo, rebuffed. We heard that overnight. And the real drive for that bid is trying to get its hands on Anglo's 700,000 odd tonnes per annum of copper production. Mark Bristow at Barrick, big gold miner, has come out and said he really likes copper and we're not going to have enough copper. And Rio hasn't ruled out making a play for Anglo either for its copper. So copper is very popular, and there's a number of really good fundamental drivers as to why in the long term copper looks very, very positive. Next slide, please. And one of those drivers is a big driver is electrification, and a growing source of demand for electrification is artificial intelligence and data centers. And this is just a slide showing the US demand for power from things like electric vehicles and data centers. And I think Canaccord came out recently and estimated that up to another 6 million tonnes of copper cumulatively could be required for data centers just through to 2030. So that's a massive amount if you're thinking that current global consumption is 27 million tonnes a year. Next slide, please. The Goldman Sachs also forecasting deficits, and it's just increased its forecast deficit for 2026. So that's they're forecasting a 700,000 tonne per annum deficit by 2026. Look, and the amount of metal required for producing power has doubled, up by 50% in the last 15 years. So every kilowatt of power has a much greater metal intensity, and the major metal that goes into that is of course copper. Next one. So here's an estimate. There's been, across the resources sector, there's been underinvestment from oil and gas right through to base metals, and copper is one of the standouts in terms of the underinvestment that has occurred, and that's just built up a big requirement for additional investment to try and meet the forecast supply gap over the next 7 or 8 years. This CRU group chart shows that we need another 150 billion invested in copper mining to try and fill that gap. Next slide, please. So turning to the OPEC of copper, Chile, the country, it produces nearly 20% of the world's copper consumption, 5 million tonnes per annum. Far away, above and away ahead of the next largest producer, which is Peru, at 2.6 million tonnes per annum. But looking sort of a bit more granularly at how Chile's been going in trying to ramp up its production. So 2023 was its lowest production for 15 years. 2024 is forecast by the State Copper Company to increase its copper production somewhat, but it's already had to downgrade that increased forecast, and we're not even halfway through the year. They are forecasting a greater, another step up next year, but it's not easy. I think PricewaterhouseCoopers came out with a report in the last couple of weeks saying that 50% of the world's copper production by 2050 will be in heavily drought affected areas, and you can't mine copper without, or can't process copper without water. So there's a real threat to existing copper production, let alone new copper production. Next slide, please. Just turning to recycling, is that going to fill the gap? If we need another 8 million tonnes a year by 2032, is recycling going to be able to step in there? Well, as the copper price goes up, and it has been going up, you will see increased recycling. You'll also see increased, theft of copper from power lines and railways and things. But at 5 odd million tonnes a year of recycling out of possibly a requirement of up to 50 million tonnes by 2050, you can see recycling sort of flat line through to 2021 for 5 or 6 years. So it does look pretty unlikely that recycling will be able to fill that gap. Next slide, please. So what's happening at the moment? Copper processing fees, TCRCs, as many people might have heard, have turned negative in China. That's probably got a couple of causes. One is the extra smelting capacity that the Chinese have been building, but the other is the lack of supply of copper concentrate. Things like Cobre Panama going offline take a big chunk of concentrate out of the market. So from a concentrate point of view, things are very tight. Next slide, please. One of the anomalies, though, in the current market is that we've seen the copper price jump, but we've also seen copper inventories, visible copper inventories in warehouses jump as well. So you can see that Shanghai Futures Exchange warehouse stocks are at a 4-year high. That's a seasonal high. Generally around this time of year, you do see inventories peak, but it is a bit of a head scratcher why you're seeing higher inventories at the same time as the copper price is going higher. Next slide, please. This represents that just again, you can see the brighter green is the Shanghai Futures Exchange. So China, the inventories are growing and they're exporting more copper. So it does indicate that the Chinese market, which is about 50% of consumption, is comfortably supplied at the moment. Next slide, please. Another indicator of that is the contango. So the copper contango, which is the spot versus 3-month spread, is the widest it's been, I think, going back to LME records in 1994. So that also indicates that there's adequate supply at the moment for spot, but gets a little bit tighter as you go forward. Next slide, please. The other thing that's I've noticed is the coincidence of metals bouncing since February. You can see this is tin and zinc and copper all have almost synchronously jumped since around February. Next slide, please. And similarly with gold. So look, I think one of the reasons for this is we saw a report from Bloomberg a couple of weeks ago saying that some three of the big oil traders, including Vitol and Gunvor, are back in the metals market. They left the metals markets some time ago, but they're back in. So I think we're seeing some traders pushing the price up, and there is some speculation in the price at the moment for copper. Next slide, please. I mentioned earlier that China is takes the lion's share of copper consumption at the moment, and I'm sure everyone's heard about the Chinese property crash. But there's been a transition in terms of copper demand in China, moving from the real estate sector through to the energy transition sector, and that's includes EVs, EV chargers, and wind turbines and power lines and all sorts of things. So that demand has really been taken up and is increasing, forecast to increase as a result of the energy transition. Next slide, please. So look, things look very positive for copper, particularly in the long term. Just a cautionary note, what can go wrong? So obviously China, the demand can fall there. The economy can, go into recession, if you like. But it's interesting to see what happened with nickel. Like a few years ago, Elon Musk was begging miners to produce more nickel. We didn't know where his nickel was going to come from building his Teslas. And you go back 10 years and you were seeing people, this chart calling for a shortage of nickel by 2016. But next slide, please. If you go to today, you can see that the forecast shortage in nickel is not until 2030, and the reasons for that are partly thrifting by the EV makers, but largely because the Chinese have come up with a new processing technology to produce battery grade nickel, and Indonesia's as a result moved from a relatively small player in the nickel market to being 50% of the supply. So could that happen in copper? Well, copper is a much bigger market, but there are technologies being worked on, particularly in processing more difficult ores. I know, Rio Tinto working on their Newton sulfide leach technology in the Americas. That could be somewhat of a game changer for supplying additional copper. But the market is much bigger. The copper market is much bigger than nickel, about 10 times the size, and there's a bigger shortfall forecast as well. So that might be part of the answer, but it's certainly not the only answer. Next slide, please. And then just another metal that is interesting, just in terms of many people calling for higher metal prices over a very, very long term, and that was uranium. We saw probably 10 to 15 years of forecast every year, analysts forecasting higher prices, and it didn't happen. Uranium went down and down and down. But eventually, dreams can come true. And last year we saw the uranium price spike to over $100 a pound. So it can take a long time for metals to realize the forecast, but it certainly can happen, and it can happen very quickly. Next slide, please. Finally, just a plug for our little fund. We do, this is to give investors some heart that you can make really good returns in the junior resources by investing in companies like the ones that we're about to hear from. So that's it from me. Thank you, David.
Thanks, John. Do have time for a quick question, and it probably flows on a little bit from the slide you've just presented. Where does the fund see the best value in copper equities at the moment?
Yeah, look, I think we are naturally focused on the pre-development companies, and I think from some of my slides I've shown earlier, you have seen some of the the majors and the bigger producers run and have better share price performance than the real juniors. So we expect that there should be and could be a trickle-down effect. and it's the juniors that have hopefully going to catch up and go past the big companies, and certainly that's where you get the leverage. So that's where we that's where our portfolio is focused.
Thanks, John. A great presentation, and clearly set the scene for the presentations to come. Thanks for your time and your insights.
It's a pleasure.